Thank you guys so much for joining us in these trainings that we do. It's all about investing in ourselves and becoming better version of ourselves. One of the things that I did a long time ago was when I started in the business was just start training and start learning, and this is really what we want to do here is just encourage you guys to continue that journey of learning and getting better and investing in yourself and betting on yourself, right? So that you can produce better results. Today I'm going to do a presentation about FHA PMI versus conventional, and it's geared for people that want to know the differences, right? And we'll just get right into that once we talk about that. But before then, I'd like to talk about getting comfortable with pricing loans out. I know a lot of us struggle with how are we going to price a loan out, right? What is a fair thing to charge? And I have Hugo here. He's one of our loan officers, and he has volunteered to share his insights on what he's learned and what he's doing to negotiate terms, interest rate, and all that with his buyers. So, Hugo, are you on the call?
Yes. Can you hear me?
Yes. And again, thank you so much. I appreciate you doing this. It's always good to get insights from other people other than the broker, right? So let's hear it.
Mm-hmm. For sure. So hello, everyone. I'm just going to give my insights on how I go about negotiating my fee, right? Pricing is such an important thing. It's the basis by which people will shop you if they're talking to other loan officers. And in this environment where, loans are very competitive and people are completely open to talking to whoever they want, you want to make sure you have the tools to be able to negotiate your commission and what you know is a fair price for your services. So I'm going to talk about a couple of the things that I look out for and the way I make my decisions, and then I'll probably give some examples of some of the situations that I've been in and how I basically got what I think I deserved. So I think the most important thing by far is understanding the market and how people are charging throughout, right? So the most basic thing that I could recommend to everyone is have an idea of what the average mortgage rates are looking like for every type of loan product, right? What's the average conventional in the US right now? What's the average VA loan right now, et cetera? And that's like a basis point. That way, because sometimes you'll have borrowers who are reading the internet and they're reading some Yahoo News article that's actually from 2 weeks ago. And they said, wait, they said that the rates are at 6.5. And when I have the daily average, I could show them that and say, hey, actually, that's a little outdated. This is what it's looking like today. So you could see today the average rates are 6.875, and I'm offering you a 6.75, right? And it gives them some perspective that it educates them to kind of know that your fee is right. And aside from knowing the market, you got to know what other loan officers are doing or what other, like who you're competing with, right? Because if you are aware, let's just do an example. If you're aware that for 30-year conventionals, you're probably dealing with a 6.75 rate. Let's just say that, right? And then you're working with the borrower and then they say, hey, so I have somebody that's offering 5.99 with no points. Can you match that? Now, that might sound a little scary because you start to wonder, am I pricing it way off? Am I just not competitive? And the answer is no, because you know the market and you know that 5.99 on a 30-year conventional is ridiculous and it's not true. It's a lie. So of course you don't tell the borrower, hey, you're lying to me. You ask them, hey, are they pricing you at an FHA? And then what if the borrower didn't know that? And they said, oh yeah, it is an FHA. And then I say, oh, okay, because my FHA is 5.75, right? And, or they say, yeah, it's a 30-year conventional. And then I ask a couple more questions, right? I try to find out if they are speaking to a credit union where they might have some kind of relationship with them. But even then, 5.99 sounds a little too good to be true. So you kind of have to hear out where they're at. If they're close, if they're saying, oh, they offer 6.625, then you could consider adjusting your commission. Maybe you are trying to make 1.5% of the loan amount in that scenario, but you know that it wouldn't cost you that much to, maybe make 1.375 on this one. Depends on the deals, right? You have to have an understanding of like what kind of work you're going to put into it, if there's any like tough sticking points to the loan. For me personally, if it's an easy loan, if they have like an 800 FICO, W-2, it's the clean file, and I'm expecting to make 1.75%, and a competing loan officer is offering a slightly better rate, well, I'm going to choose to match that and lower my commission a little bit, because I know the deal is going to be very doable and I want the deal, right? And so it's a balancing act. It's a balancing act between the market, how much you want to make, but also how hard the file is, how complex the file is. And when you balance all those things, you could defend your commission more readily by knowing what's out there and knowing what you're worth on that file. Like, I would advise against just having a hard number and just being like, I'm charging 2% on every loan that I do. That, I think, it'll blow you out in a lot of negotiations. And then another point I want to make is knowing your borrower, right? If it is somebody, like, you'll get the sense of it where up front that they are a heavy negotiator, right? Everything that matters to them is the dollar. So they're asking you for exact detail on the closing costs. They're asking you about the rate. They're very inquisitive. Then that this is probably someone that might be talking to 5 other loan officers. So you lead out with your best foot forward. You want this deal. Maybe you don't start at 2%. You start at your 1.5. You start maybe lower. You have to be the judge of the layout of the competition. And when you set the right expectations up front, it's easier to defend later when it comes into question. It's also easier to go down by a little bit than to go down by a lot. If you try to get away with like 3%, and then you find out you have competition, and then you lower it to 1.5% of the loan amount, well, then the question is going to be, well, why'd you start off so high and now suddenly you go so low? And then you might lose the deal anyway, even if you have a better rate or fees than the other loan officers. So that's a lot of how I look at it. And one of the examples I want to give happened recently, actually, where I was doing a DSCR loan and I was pricing it out with a client who is very inquisitive and told me doesn't like surprises. He wants to know how every single thing works. So I got the estimate on the closing costs, right? I knew exactly what kind of property taxes I was working with the knowing what I was working with on the insurance, calculated the prepaids based on when I thought we would close the loan, and all of that, right? To get to an accurate range. He sends me an email that shows me that I'm off by about 3,000. So somebody was offering up to 12,000 in closing costs for a 6.5 rate on a DSCR. Now that's very good, and he's paying some points to get there. But I was off, and I was a little surprised because I was using a very strong lender with DSCRs. That's Blue Point Mortgage, by the way. And so I was very surprised that somebody was beating me by that much. So I was willing to drop my commission down to about 1.25 to get there. And so we were good to go. Then he sends me, and this is on accident, he sends me a competing loan officer's loan estimate with just like a certain section of it. And it revealed to me that this loan estimate that I was competing against had a rate of 7.25. So here I am competing with a 6.5 rate against a 7.25 rate, and the comparison is not even fair. if they charge 12,000 at 7.25, I charge like 3,000 at 7.25. So he was trying to sort of hustle me into just getting the best rate for himself. So because I know the market, because I know that my pricing is competitive, I called him out on it. I said, "Hey, you're comparing a 7.25 estimate to my 6.5 estimate. That's not a fair comparison. And the only way to get there at this rate is to cut my commission." And I straight up told the borrower this: I've worked hard with you. I've answered calls on weekends at 9 p.m. I've been very transparent with you. And so I told him, "Hey, so I cannot cut my commission if we're not being transparent with each other. So my fees are actually just the 14,000 that I said initially." And at that point, he kind of he felt bad that he did that, and now we're still negotiating. And I'm willing to still cut some part of my commission to get us there, but not to the degree that I was before. And he knows that, and that's negotiations sometimes. Like, he knows he doesn't have the leverage anymore because he kind of tried to play me. But at the same time, you keep it professional, right? I wasn't upset and I wasn't mad. I just told him, "Hey, I'm being transparent with you every step of the way. So these are the fees, and we could try to structure the loan to make it work for you." And now we're considering a 6.75 rate where I could get him some lender credits to really improve his pricing. And so we're working on that now. But it's a thing that happens, and you can't be afraid to know your worth and to have your commission set. You just have to know the market, and you have to know your products, and you have to know what's out there and what you're competing against and who your borrowers are. So yeah, that's my spiel, Pablo.
All right, thank you so much for sharing all that.
Mm-hmm.
And it does help that here at Equity Smart we can we don't really have any minimums. I know some companies you go and work there and they want you to collect at least 1.25, 1.5, and you can't go below that. And so you have that competitive edge because that's going to be a majority of broker shops out there that require minimums. And so that's done on purpose so that you guys can compete and win deals every single time and not have compensation get in the way. And a great example, I mean, everything that Hugo said on T, you just, I like how he talked about different areas of the pricing, things that can come up with different borrowers, right? Are they malleable? Are they, tough? Or, what are they doing? They're trying to get a great deal, and they might not be looking at the right program, talking to the right person, or be in the right situation. So you got to inquire as how they're getting that quote, right? And in most cases, you ask a simple question: have you submitted an application? And they're going to say no, which means that they just got kind of a quote over the phone, right? So that makes you question, okay, is this a legitimate quote that they're getting? And again, I mean, you don't want to get into on the wrong side with the customer. You want to show them that you're trying to get them the best deal at all times, right? Because the moment that they feel that they can't work with you or you're being tough on them, they might go the other way. So you got to be really careful when you do that as well. Uh, for me, just asking all the right questions makes a world of difference because it kind of really lets you know where you stand. Now, when you're pre-approving a borrower, just know this, right? They're calling you, and the borrower's mindset is, I need to know what the rates are to decide which borrower I'm going to work with, right? Or I'm sorry, which loan officer I'm going to work with. They haven't found the house yet. They just need to pre-qualify, and they want to make sure they're going to work with the right loan officer. We all know that in the pre-qualification part of things, uh, the rate's not locked. So regardless of whatever rate you give them, it's going to expire at the end of that day, and they're going to have to get a new quote the next day and the following day and so on. So what I do, and piggybacking off of what Hugo does, is I'll go and I'll see on average where maybe one of the lenders I like working with, right? Let's say United Wholesale Mortgage as an example, and I know from working with them that if I wanted to, I could find a lender that's priced maybe a quarter to 0.375 better in rebates, maybe even half a point in some cases than they are, right? So then if I see that they're quoting a rate at 6.25, then I might tell my bar right now our rates are going anywhere from 6% to 6.25, right? Just give a quarter range so that they know that I can go lower than a 6.25 if need be. So I'll give them a range and I'll explain to them that this rate is no good until they're able to find a property and lock in an interest rate. Now they might ask, well, don't you guys have like a lock and shop program or anything like that? And you say yes. The only issue with that though is that, I tell bars, especially depending on where we're at, right? Right now, I think rates have already peaked out. I don't think they're going to go back up. And if anything, they might start improving, right? So we really don't know. But the problem with some of these lock-in shops is they'll do a 60 day or 90-day pricing. So you're already going to start with a really high rate because looking into some of these programs that do have these lock-in shops, it just, for me, sometimes it just doesn't make sense. It's better for them to say, hey, just go find your property, and that way I can get you like on a 22-day lock. You're going to get better pricing. And but you want to let them know that you're competitive and you can get the rate from the get-go, that you're not stuck at whatever rate, because they might call another loan officer. Another loan officer might say, well, I can get you a 5.875, right? And that's really not the time to be shopping for the rate anyways. But you still want to get the application, get them pre-approved, and send them off shopping, right? So that's why it's important to ask all those questions to make sure what really matters to the customer. And for me, it's always been a process of educating them and helping them understand how the process really works and what value you're going to bring to the table as you're working with them throughout the transaction, right? From answering the phone to being able to explain things to being able to, one of the things I always remind sellers is or borrowers is that, hey, the agent's going to give me a call. They're going to want to verify the pre-approval letter. I have to be sharp. I have to know how to sell myself and convince them to accept the offer. And I'm really good at it. Buyer's selling listing agent calls me, hey, we're verifying the pre-approval. I'm friendly, I'm nice. I even go as far as telling the listing agent, I know that one of the most important things for you is a loan officer that communicates. I've been doing this for quite some time, and one of the things that I promise I'll do throughout the transaction is communicate, so that I'm also helping the borrower get his offer accepted, right? I want to be instrumental to that. And there's been a lot of times where the conversation that I had with that agent or that loan officer on the other side made a huge difference in getting my offers accepted or my buyer's offers accepted, right? One thing I never do is I never send out loan estimates, right? Because now when you send out a loan estimate, now they can email that to whoever they want, and now the other person knows what they got to beat, right?
Mhm.
So I always tell them, hey, if you get a deal, get me the loan estimate, and then I could put something in writing for you in terms of like a loan fee or anything like that. And if you
I
must,
I was
yeah,
gonna
go
say
ahead.
I was gonna say I like that where for example on my pre-approvals for a purchase I talk about what rate range we're in, and maybe I even tell them I could do this today, this exact rate today if we did it today. But when I give my pre-approval letter on I use Equity Smarts template that they have on the my ESHL website. There's a section that asks for the rate, and I always put TBD on there because I don't want, first of all, if somebody else comes in, if the pricing gets better, and I was offering 6.5 a week ago, and then today, if the rate is like 6.25 and another lender says I could do 6.25, then I'm the one that looks bad because I was stuck on 6.5, and that's what it says on my approval letter. So I like to keep that as TBD, and I let them know on the day that we need to lock, we'll know the rates then, and I'll tell you where we're at. And they're usually completely okay with it. Like I like what you said about not doing your own loan estimate right away. You want to keep your cards hidden as well. Like it's a balancing act. It's a game that you have to know how to play.
Yes,
Yeah.
and
Yeah.
go ahead, Hugo.
Oh no, I was just gonna say because I saw a question from Julian, where he's asking at what point would you have felt this was not the borrower for you, if they continue to hassle you on rates fees. And I think that's a great question because it's a judgment call, right? sometimes you know that they are after the rate. So I like to have a conversation with them at a certain point where we're talking about fees and everything. And I say, hey, so look, you know that I've been working hard for you, that I keep everything transparent. Um, I just want to know that if we are moving forward, that at the very least, you'll allow me to be competitive with any other rates. But if I come in and I lock it and then someone else just beats me by like $50 on the closing costs, I just want to know, I want your commitment that you're going to see all the work that I do and you're willing to stick it out with me because you know that I am providing you with competitive pricing. And then I get a sense from that, right? And if I just know they're really not about it and they don't care, I'll give them my best rate. And then if they shop to find someone else, I already know it's a really good rate. So then I'll say, see ya. Like, I'm okay with that because who knows that if we do get into escrow, they're not just going to shop me again after I lock it, after they tell me to lock it, you know?
Yeah, got it. So at the moment in this career, you haven't, or you're not planning to do like before you lock it, they come back at you. Like, I guess my question is, at what point do you be like, hey, this is the line. Like, I'm not lowering my commission down to zero point 0.3 of the loan amount.
Well, at a certain point, I start pinning it on the market, right? So it's like, I know that my fee, like, let's say I've lowered it to the point where I'm only making like 1.375 on a purchase, let's just say, right? Um, that's the fee. And then now I'm saying everything could change based on the rate. If they then try to say that I need to lower my commission or go below that, I will tell them, hey, I've already lowered my commission by this much, this much. This is my standard fee. Um, I'll try to get the appraisal waiver. Like I kind of shifted over to other things that I can do for them that typically ends up making them feel better about it, right? I don't just say, nope, it is immovable, it's impossible, that's it, right? I say, let me see if I can get you some more lender credits. And then at that point, I know that I might shop it with a different lender and maybe I don't get UWM, which I wanted to use, but then I go for maybe NMSI, who's got better conventional rates. Now I give them lower closing costs, but I still keep my commission. And, I might just close in 15 days instead of like 10 days with UWM, and like that's the judgment call I have to make.
All right, good stuff, Hugo. Thank you for sharing. And
Mm-hmm.
two things that I've done in the past is, you know, one of the things that as humans we like to get deals, right? We like to feel like, oh man, I got a good deal. Anytime anyone buys a car, clothes, shirt, or anything, hey bro, check out the deal I got on this watch or car or whatever, right? Same thing with interest rates, right? Some people when they get a low interest rate, they like to brag, oh, hey man, I got a 2.5. Can you believe this, right? And so what I would do in the past is I would, let's say I'm gonna sell the customer at a 6.25. I know that 6.25 is a good rate. I'm making, decent income, maybe not killing it, but happy enough with what I'm making. And when I start the conversation, hey, great news. The interest rate's actually 6.5, but because you were referred by such and such, you're going to get a deal today. I'm going to give you an eighth off of it, so your actual interest rate is going to be 6.375, right? So you can do something like that. Believe it or not, that psychology works a lot because like, oh wow, he's hooking me up right off the gate, right? And of course, you want to price it to where you want to land, and then back into it so that you're not going lower from where you really want to be. And that's a great way to just work on the psychology of the borrower. The other thing too is that you can do is uh, if you have a what was I going to say? This is one that I used to use all the time. If you have a just drew a blank. But anyhow, getting back to that other one, just price it out. Make sure that you're gonna, if you're looking to make 2 or 3 thousand bucks on it, make sure that you bump up the rate a little bit and then come back down. Now, another thing that I used to do, and this might start happening soon, as soon as we start getting refis, especially now that we're making income on HELOCs, right? So you could say, I know that which lender's paying almost 2 points on HELOCs right now? Is it Homebridge, Remen, or forgot who it is, Cemetery? they're paying up to almost 2%. And what you can say, hey, the rate's 6.5, but if you take on a HELOC, I can shave off an eighth, and then you're able to get two loans, right? And I'm talking about maybe a refi that's at 40, 50% LTV, and you want to get them a HELOC for another 20-30%, right? So now you're making income on the first and the second, and you're going to process the same paperwork that you're probably going to need on the first for the seconds, and then you can close them concurrently as well. So that way you're able to make up that income with having an additional loan on there as a line of credit. Trying to think about the other thing I was going to say. Anyone want to add anything on else there that they're doing that has made a huge difference in what they're doing, while I try to remember what I was going to say?
I also have some thoughts on when you're willing to walk away, right? I think what helps a lot of times in these negotiations is being very open up front and saying that it's totally okay if they talk to other loan officers, that, yeah, totally fine. I'll just try to be competitive with them. Then they see you less as the person that's trying to win the business, and more as somebody who's being honest and being confident that you can hang with any offer that's out there. And then on top of that, being willing to walk away when it is a very good deal. Sometimes I see deals that I don't know how they got there. Like, it is crazy to me how they could do that. But you don't know why they have that, right? It could be some relationship they have with the credit union that you can't compete with. It could be that that bank does portfolio lending where they hold on to the loan for a long time, so thus they're willing to offer a better rate. And then you have to decide, okay, I can't compete with the rate. Can I compete with the service? And a lot of times in those situations, you can, right? If you're dealing with a commercial bank, then their service is not going to be that great. They might not close that quickly. And if you know that you're in the middle of a deal that needs to be done fast, then you could approach it that way. Say, hey, I'm at 6.5. I see they're at 6.25. However, now it's a timing thing, right? I can get it closed in 10 to 15 days. And just look up the reviews for this bank, and you could see plenty of people complaining about not closing within 45 days. And you play that game. I Google all the time who I'm competing with. I try to see what they do. Now, if all things considered, it's a reputable lender that they're using, the loan officer has a good reputation, they are somehow offering a much better rate, it could mean that they're very willing to just make almost no money on it. And I know I'm not willing to compete with that. So I will tell them, hey, to be honest, that is a very good rate. You should go with that. I'm here with the loan just in case things don't work out, and keep you in mind, blah, blah, blah. And, people are happy to hear that. And then sometimes they'll come back. Sometimes they'll find out that that was a lie. Some people do bait and switch. And if you just keep it open and honest, they might come back to you after they find out that the other person tried to do something shady.
Yeah, so great stuff there, and just remember, if anyone's price, if you're at, if you look at the rate sheet and you're seeing par pricing with one of our best lenders, and they're still beating you, it's just something's going on there, like Hugo said, and you got to kind of just ask, and that's where, asking if they even took an application, this and that, or they're working with a credit union. And yeah, some banks, unfortunately, they can lend on their own money, and they can call the rules and do whatever they'd like, especially if they have bank accounts and all that great stuff, with them, checking and credit cards and all that. So it can make a difference, but you'll find that that's not often the case, though. Those are rare things that happen. So getting back to what I forgot I was going to tell, but now I just remembered, is so one thing that I used to always do was, because the bars left feeling insecure, right? Am I really working with the right guy? And what if I lock and the rates go down? And that's where you say, you know what? We have a rate protection plan. The rate protection plan works like this. If I lock you in, and during the middle of the transaction, if feasible, because they're in a purchase transaction, you're going to say, if feasible, if rates go down, then I have the opportunity to renegotiate your rate, which is true. A lot of the lenders have a policy where if the rate, and I don't know if it's a quarter now or half a point on the rebate, but if there's an adjustment, I think on eighth of the interest rate and half on rebate, the lender will renegotiate with you the price, because we've had that happen in the past where rates are dropping all of a sudden. And then it also gives you the opportunity, if that lender doesn't want to renegotiate the rate, then you can always submit it somewhere else, right? I mean, none of us like to do that, want to do that, but let's say that the rates drop all of a sudden, and the customer's aware of it, right? Because they're talking about it on NPR, on the news, or wherever they're listening to, and like, hey, Pablo, this morning I heard that rates dropped. Can you get me a better interest rate? Hey, we're already locked in, depending on how deep we're into it, right? And sometimes it behooves us, and it's in our best interest to give them a lower, a little bit lower rate if the rates drop, because we don't want to get hit with the EPO either, right? Early payoff, if they're too high, because you don't want them to close and then refi, right? If you start to see that happening. But just mentioning that, hey, I can offer you a rate protection plan that I do. How does it work? You explain it. Hey, well, the benefits of me being a broker is that I work with over 150 lenders. I'm constantly monitoring the interest rate. If I see that it makes sense to either renegotiate your interest rate or switch lenders, I have the ability to do that, and I can do that pretty quick, whereas other lenders might not be able to do that, right? You bringing that up, just bringing it up is going to give the bar a huge peace of mind, knowing that you have those abilities to do that, and that if the rates do happen to move more favorably, that you're going to be able to do something about it. And to be honest, I said that a lot throughout my career, and it's very few times where I actually had to exercise that, because I left them with that peace of mind, knowing that the deal is going to go through. And I think was one occasion where the rates were kind of going down, and I did want to get them something better, and I also did that as well. Other opportunities you can look for is, and I think I mentioned this on the credit training, was if the customer has a borderline FICO score, and I don't know, Hugo, if you come across this yet, where you have a bar that maybe like at a 695, right? And that 700, just getting them those extra 5 points is going to make a huge difference. And not only that, on a conventional loan, it makes a huge difference, not just on the interest rate, but don't forget on the PMI. It helps to also bring down the PMI. So you can show them the two areas where they're going to save money, and that could make a huge difference. And say, hey, I have this plan for you. We're going to be able to get you a better rate. You just got to go along with me. And by the way, you don't have to ask permission to pull the what if simulators that are inside of our credit tools and Funding Suite, Advantage Credit, and all that. You can just pull them. In fact, I think Funding Suite, in the very bottom, without even pulling it, it'll tell you, hey, there's opportunities to raise a score. The customer has a American Express card that he's not responsible for, and you could even do a rescore without the bar even knowing it, because it could be paperless. And by the time you get to the 15th day, you say, hey, I got good news for you. I rescored you, and I'm able to get you even a little bit better pricing on your rate and your PMI. I've done that quite a few times, actually. So look for those opportunities that'll give you an edge also on the pricing. And those are huge. So always look at the credit. How far am I from a 720? How far am I from a 740? How far am I from a 680? Those milestone rates are going to help you get even a little bit better pricing, depending on the bar's situation, right? So remember, you guys have a rate protection plan. That's one of your tools in your tool belt. You can work with other lenders if you need to. All right.
Pablo,
All right. Let's go ahead.
can I just add something? Like when you were talking about locking the rates, something I try to tell them too, that they have the option, right, to float and lock, the pros and cons of both, right? And I tell them sometimes it's a commitment both ways. So when they lock and the rate, they come back to, hey, did the rates drop? They dropped a little bit, right? But then when you educate them, you told them, hey, but remember, if the rates go up, they're not gonna go say, hey, the rates went up, we're gonna give you a higher rate. No, they're respecting you that you locked that rate. They're not. So how would it's not a fair thing that, oh, now the rates went down and you want it lower, but they're also taking the risk that if the rates go up, they already locked you at the lower rate. So when I tell them, they get it, right, where it's like, okay, it sounds fair.
Yeah, and I like that. I'm glad you brought that up, Pete, because if you explain the lock policies to them, they'll understand that there's a whole system in place regarding locking the interest rate, and versus, let's say, floating it, right? I'm in the preference that, let's just lock it, forget it, and let's close, right? Because you don't want the rates to get away from the borrower. So if you lock and the rates go up, you're going to be a hero. If you lock and the rates go down, you still have the rate protection plan that I mentioned, right? Where you can bail them out and put them on, either renegotiate with the lender. And I would call my AE right away, first thing, without switching the lender, say, hey, rates went down by 3/4 of a point, bars shopping around. We got this ready to pre-approve. Is there any concessions you can make? I don't want to move the loan. And you'll see more times than often they'll make concessions. Like, okay, let's do it. And so that's another thing that you can ask for. Don't ever be afraid to ask for concessions with your AEs and say, hey, I'll take care of you on the next one. Sometimes our AEs have some wiggle room. Their own companies tell them, hey, you have a quarter to play with if a loan officer asks, right? So make sure you ask those questions, even when you find yourself, even before you lock, if you find yourself in a competitive situation, especially if it's an AE that wants to earn your business and establish something with you and get something going with you, that's a great opportunity to do that. But educating them on the lock is a great way. For me, my advice is just lock and sell the rate protection plan, because if they even decide to float on their own and their rates get away from us, then the borrower can be in a situation where they're paying a lot more than what they imagine. But again, if they choose to do that, then it's going to be on them, right? All right. Anything else that we want to add on here on this topic? Any other questions? Anyone have any lock stories they want to share, or any insights of what they're doing?
Oh, it's not a story, but something I saw on the brokers are better, that when shopping with retail, they're seeing that when you give your quote or whatnot, they come back and, oh, look at, they gave me this rate. But like retail is a little bit more difficult, where they have to ask permission to drop it again. So like when you're competing, don't go way too low. Just go enough to beat them, because then at that point they might not be able to come back anymore and beat you. And if they do, you still have even more wiggle room. And if they ask you, oh, why didn't you give me this rate at the beginning? You remind them, remember, rates are changing daily throughout the day, right? And just tell them that.
Correct. But again, you'll find and again, I think that Julian, you were asking these questions about what if you're in these situations, and what you'll see is that over time, as you become a better salesperson and a good negotiator, and you're good at making people feel comfortable, you've gained their trust. You're not going to find yourself in too many of these type of situations. Hey, you were recommended by Rebecca at Keller Williams, and if she says you're good, you're already like 90% in, right? But I think we're focusing on those situations where this does become, you find yourself, trying to deal with a very rate sensitive borrower. Have I ever lost a customer, because a borrower, I wouldn't give them a rate they wanted? Yes, I've let borrowers walk away, and I've moved on to other bars just because they brought me to a point where it just wasn't going to make sense anymore, right? And whether it was unrealistic or not, I just had to hold my ground. I've done that and had plenty of bars come back, like Hugo mentioned, and continue the process with me when they realized that the other loan officer didn't really give them a real quote, that they hadn't pulled credit or they hadn't done some other work, and it just made me all look stronger. So you just gotta be tough and let the deal walk if you have to. And sometimes they're just bluffing, and they'll be working with you anyways. All right, let's see, anything else on here, anything else on the chat?
I got a quick question, Pablo.
Yes.
I'm sorry, could you go back again to the rate protection thing, because I've been like in and out, and I think I missed. What is that rate protection thing?
The rate, it's not like a formal policy that we have. It's like, it's your own policy that you're gonna let the borrower know, like, hey, I do rate protection, which is if the rates happen to go down after we lock and we're in the middle of the process and it's feasible,
Mm-hmm.
meaning that we have time
Mm-hmm.
to close and we have time to make the move, then I will go out of my way to make sure that I can either renegotiate the interest rate with the current lender or transplant the loan with another lender, right?
Mm-hmm.
So that way you're giving the borrower on the onset a peace of mind that you have exit strategies for them in case the rates go down, right? And where you might get these questions is when we hear the politicians and the news saying, "Oh, rates are going to be going down soon. Rates are going to be going down soon," and so people have that in their mind. So that's when these questions start coming up, right? In a rising market, you're not going to have that too many of those questions. People are going to just want to lock and protect the rate. But that's a cool thing, because if the lender doesn't want to renegotiate, then we can go to, from UWM, we could go to NMSI or any of those lenders that are priced really well, and renegotiate the rate, or submit the loan with a lender that's going to give us better pricing. So that's what that really is. It's just your own personal plan that you're going to tell the borrower, like, hey, I have this
Okay.
rate protection. You're also going to give them a discount. Remember, you're going to say, hey, normally the rates are 6.5, but because you were referred by my cousin, you're the realtor, whoever you want to mention, give them credit. Say, I'm going to give you actually an eighth off. I normally don't do this, but and I'm going to give you the rate at 6.375, right? And then the customer feels automatically like, wow, I got hooked up. I got a discount. That feels good, right? Doesn't that feel good if someone told you, hey, I'm selling you a car for $20,000, but I'm going to knock off $1,000 off the price? How are you going to feel? You're going to feel like, wow, cool, right? I got the car for 19,000 instead of 20,000, right? It's a good feeling, no matter how you chop it and slice it. So you want to create that, and then if they get HELOCs, you can do the piggyback HELOC thing, and give them discounts there. And there's other hat tricks that you can do, but they're all intended to help the bar just feel comfortable, and that's really what we're trying to do, is just let the bar know that they're working with the right person. At the end of the day, that's what they want to feel like. Okay, I got Dan Cruz, I got Pablo, Pete on my side. They're going to do the job that needs to be done to get this deal done, right? All right, anything else, Hugo, you want to add? I don't know if
No,
Hugo's still.
just if anybody has any thoughts, or they want to, if they're in the middle of pricing and they want to know if they're doing something right, competitive, etc., feel free to reach out to me. Give me a call. I make myself available to help out anybody who just wants to talk shop and see if they're doing the right thing. So yeah.
Awesome. And this is a perfect time to segue into part of the training I wanted to do into knowing your programs, because this has to do with saving the bar money and putting them into the right programs, right? So can you guys see what I just put up on the screen? All right, perfect. All right, so really quick, I just wanted to make sure that everyone understands the differences between FHA and conventional loans, and what the major differences are, right? If you already know this stuff, then just bear with us. We just want to go through it one more time, make sure that everyone understands this. But and feel free to chime in, anyone that wants to chime in on this conversation or this topic. But FHA loans, as we all know, they're government-backed loans, and the reason we love them is because they make it super easy for the borrower to get into a property. Number one, that you can have gift funds. I mean, the borrower does not need to come in with their own money, in the sense that the actual down payment can be gifted, and also the closing costs can be covered by the seller, making the program a true no out of pocket for an FHA borrower. FICO score restrictions, when you run these loans through DU, it's very, very DTI friendly, where you can get an approval up to maybe a front end of 40. I think I've seen it at 46.99 on the front, the housing ratio. And on the back end, you can go as high as 55.99, what I've seen on the back. Usually going to be with a 680 FICO or higher. But you can do these with a 580 FICO or lower, and you can still do a manual underwrite with extenuating circumstances. And so it's a very great flexible program. You can have, I think, up to 5 people on here. It is owner occupied. And the only thing we have to contend with, which is I'll show you on the next screen as well, is a private mortgage insurance, right? So FHA, we know, requires an upfront mortgage insurance, and it's pretty expensive. It's a 1.75% of the loan amount. So if you have $100,000 loan amount, the upfront mortgage insurance is going to be $1,700, right? $750, and for every 100 grand. That gets financed back into the loan. And what I want you to really realize here is that FHA is actually not a loan itself. The money's coming from the agencies. What it is, it's an insurance. And what the insurance is telling the lender is, hey, if this borrower cannot make, we want you to lend this money. And because we're charging this insurance, this upfront mortgage insurance, if the borrower cannot make their payment, we're going to use this insurance to cover any foreclosure costs or any default costs that occur with the loan. So it's really an insurance actually that the borrower is getting, right? On top of that, they have to pay a monthly MI. Well, as a conventional loan, compared to a conventional loan, it's a private mortgage insurance, and there's usually never any upfront mortgage insurance, right? And you're just going to go right into a monthly mortgage insurance. And here's some of the points that I made where you can go as low as credit score as low as 500, 580 on an FHA loan. First-time home buyers, and by the way, it's not only first-time home buyers. If you haven't owned a property, I think it's 3 years, or as long as you're owner occupying the property, you can get an FHA loan. So it's a first time, but also owner occupied property. So you don't have to, you could have owned property in the past. But the main thing with this program is you just have to be able to show that you're going to live in the property. What else here? And then, like I mentioned before, the high ratios. And then on the conventional, again, there's no really any upfront mortgage insurance. You can some of the lenders are going to have programs or products where you can buy out the monthly payments by paying for a one-time upfront mortgage insurance, and that'll buy out the monthly insurance, right? So you can do that. There's usually options for that. Now, the credit score requirements on conventional, we all know it's 620. You're not going to get really, I don't think I've ever gotten a DU approval below 620. It's 620 is like a strict cutoff. There are some lenders, I don't know who does them, but I don't even think I've ever even done one, a manual underwrite with a 620 FICO score, below 620. Bars with a down payment, the bar has to have a down payment of 5 or 10%. Well, and then you have the Home Ready and the Home Possible programs that do allow for 3% down. So on those programs, it's going to be a little bit cheaper than even the FHA. All right, so let's look here at an example. So here you're going to notice the key differences. Down payment's going to be 3.5. Typically, conventional is going to be 5. But again, if they qualify for the Freddie Mac or the Home Ready program or Home Possible, then they can actually get 3% as well. But that's going to be for a certain audience. Monthly mortgage payment, including the MIP. And remember, the MIP gets financed back into the loan. So now the borrower is also paying interest on that upfront mortgage insurance. On a conventional, there's no upfront mortgage insurance, and the annual MIP is $1,125, which makes the monthly for conventionals $125. So MIP is required for life. That wasn't always the case, but they changed that. I think, I don't know, like maybe 15, 20 years ago. I remember that even on condos, you didn't actually even have monthly mortgage payments, but they continuously make changes, and that's some of the changes that they've made. So you really want to compare the differences, especially when someone is, has a good FICO, putting in very little down, and make sure that you're putting them on the right program and able to explain these differences to them, so that if you're in the situation where you're competing for rates and you're quoting off the wrong program, then that could put you at a huge disadvantage, right? Or if you could switch someone from an FHA because maybe the other loan officer didn't even consider conventional, and you're saying, wow, this guy has good job stability, they have good down payment, enough to put their 5%, and you can make it work conventional, then they might be able to get a better deal. And the cool thing is that once the property hits 80% loan to value, then they're able to cancel the MI without refinancing the property. So so they just have to contact the servicer. They'll put them through a process where they have to order the appraisal, and then from there they'll be able to cancel that. Sometimes some lenders have a 1 year waiting period before they can even do this, or 2 years. haven't looked at one in a minute, but just know that there could be a waiting period, right? So again, FHA does have 20-year, 15-year programs and stuff like that. So you want to, check the differences also as well. Now, with people, the other thing that you might want to consider too is if someone starts with an FHA, they can always refinance later on into a conventional. And that's something that we've always done in the past where you say, hey, this is just a gateway loan. Let's just get you into the property. You're coming in with 3.5% down. Your FICO's not that great. Let's work on your credit scores. Hopefully in 6 months to a year, we can get them up to where we're at, and then we can cancel, get them out of that. Hopefully they'll have, at least 80% LTV by the end of a year. Their FICOs are up, and then you get a refinance, and you're able to refinance them out, and you'll save them money on the monthly MI, and then they'll get rid of it forever, so they don't have to contend with it at all. So in conclusion, the FHA loans are a great gateway tool or entry for first-time buyers or for anyone that's trying to get into a property, maybe coming out of a bankruptcy or just a hardship, and it's demonstrated in their credit profile or the application versus someone that's conventional. But you can always work with them to get them back on track into a conventional program, right? And they're going to love you for that. And these are the type of customers that you'll have for life, and you'll always be doing all their mortgages and stuff like that. So any questions about the differences between FHA conventional? I just want to make sure everyone's clear on the differences here. Oh, and by the way, another cool thing about FHA that I've exercised myself personally is that with FHA you can do to 3 to 4 units with 3.5% down. So even some of you loan officers that may be thinking about getting some of your own 3 or 4 unit properties. That's how I started when I started buying real estate. One of the first properties that I bought in 1999 or 2000, around there, I used an FHA program, and I bought 3 units for $185,000. I used the FHA program along with the city program, and I ended up walking away from escrow with a check. Instead of bringing money into escrow, I got a check from escrow, and I ended up owning that property. That property today is worth probably like 1.23 million at least. And I just sat on it this whole time, increased the rents, and just maintained the property, right? And it was the best investment I ever made, because I literally didn't come in with any money at all. I actually, escrow cut me a check at the close of escrow. But this is something you can do with 3 to 4 units. If you don't own property and you're thinking about what should be my first property, this is a great strategy, because you can go 3 to 4 units, 3.5% down, live in the property for a year, 2 years. And then from there, you can still buy, check this out, you can still buy a single family residence with 5% down. And rent out the unit that you were living in the FHA property, and then you could still use 75% of the rents to help qualify for your new home. And that's if you do it the other way, if you buy a conventional property, you're not going to be able to take advantage of the 3 to 4 unit you get with the 3.5% down. It's a great investment. I know it's a little tougher right now, because what properties can you actually buy 3 to 4 units with that type of down payment, right? Everything is overpriced. So you definitely have to look at areas where it makes sense. But anyhow, that's if it's available to you and you come across a situation like that, and everything makes sense, that's something that you could take advantage of. All right. Any questions before we conclude here? Any comments? Anyone want to share anything? Has anyone done that yet? Has anyone taken advantage of buying 3 to 4 units? No, not yet. Okay, we got to get you there then. All right, then. I want to thank you guys so much. I hope this training was meaningful. Hugo, I want to thank you so much for taking time and sharing this valuable information. I'm in the strong belief that when you share what you've learned, it just reinforces what you've learned, and it just makes you that much stronger. And again, thank you guys so much. We'll see you guys next week.